case, right? 10% of 3,000 is just 300. Okay. You just have a $10,000 account. So relatively speaking, that's not a lot. Okay. But if you're swing trading, if you went with $3,000, right? The stock can literally do the opposite thing based on some tweet or some news or something, right? Your options can literally go to zero, right? So 3,000 can just go poof. All right. So that can happen. So if you can't risk 30% of your account on a swing, okay. So that's where this is my advice to you guys. If you swing trade, right, use less than 10% of your account, right? The bigger your account gets, use a very small percentage of your account for swing trades, because anything can happen in the market overnight, especially in the option side, because it has an expiration date tied to it. If you're swinging shares, that's totally fine because there's no expiration. You can even hold that thing forever. It's not a loss until you sell it, right? Is everyone following? Yes or no? Okay. Yes, right? You guys know this. Like if you've been around, you know, options can literally go to zero. They can literally drop to zero, right? You don't want to risk such a big amount. With that in mind, let's say you're taking a day trade, right? You're taking a day trade of this stock, right? So if you enter with $3,000 and the stock goes in your favor, that's fine. But if the stock reverses, all right, the point where you entered, so this is the retest of that trend line. If this point doesn't hold, okay, you can stop out of your trade. All right. Now, even for a day trade, sometimes you may not want to go with a full position size, right? There are certain cases where you may want to scale in, right? If that is the case, let's say you entered with $1,500, 3,000 is your full position size. So the initial breakout, you traded with 1,500, and during the retest, you want to see if the support holds. If the support is holding, you may want to add to your position. And if there is a bounce, you can take the trade. But if it doesn't bounce at all, right, you're just going to cut loss with half your position size at the retest of this trend line. All right. Now coming back to swing trading, right? So let's say the same, you entered, let's say 10% of account, $1,000 is your position size. And let's say you entered $500 here at the first break. All right. So if the stock reverses, right, but it also breaks this trend line, you may not want to stop out because you have time on your side since it's a swing trade. You want to see what happens at this strong, solid support. Okay. So this strong, solid support has not been broken for several weeks or several months, right? So chances are very high that it's going to bounce and then it's going to take off. This happens a lot of time in the stock market. They like to, market makers, hedge fund, they like to shake you out of your positions by tricking you into buying the initial break, right? So if that doesn't happen, you can always add to your position here. And when the stock eventually breaks out, you can take profits. Okay. So the key here is a lot of people ask me all the time, how can I eliminate emotions? Unraveler, I always like see the loss and I get out, right? Especially swing trading. I see a lot of people like the thing is, a lot of people see these unrealistic gains, right? Like sometimes they swing something, they're up 2,000%, 3,000%. They think that when they swing, that's going to happen to them. That gambling hope, right? Like especially when you go to Vegas, you think that you're going to win the lottery or whatever, right? That hope is what kills a lot of people, right? Don't hope for that. If you make money, you have to do it by your own strategy, right? Don't rely on hope or external factors like that. That kind of mindset will kill you. Okay. So the key here is to keep your position size small. If you want to hold on to trades longer, you don't want to get stopped out that easy. Keep your position size small. If you risk $500, right? If you risk $500, and if you can hold through 3 days, 4 days of like wild swings, because your position size is small, you may make 2x, 3x that. Maybe you can make 300% of that, right? You can make only 300%. You can only hold that for that long because your position size is small. Even in the chat, you see people posting high gains and everything, right? The reason they're doing that is because they buy 2-3 contracts, right? Not 100 contracts, right? So when you risk, right? When you risk a lot of money, there is a lot of pressure on you. No matter how experienced of a trader you are, especially when trading options, a lot of external factors can affect you. Okay. So keep your position size small. That is my advice here. Keep your position size small for swing trades, less than 10% of your account, right? And if your account is more than 100K, like keep it under 3%, 2%, use only a fraction of your account for swing trades. Okay. On the option side. All right. So that's how you can approach this trade. And the next one, if you're using Fibonacci retracement levels for day trade, for a trade entry, then the next closest level should be your stop loss, most effective in day trading, right? Augusto Peraza. So For day trades, I explained, right? So if you enter the initial break, right, you wanted to trade the breakout. That was your trade intention. Trust me on this. If your trade idea was to trade a breakout and you see a false breakout, meaning the stock broke and it broke this trend line, stop out of the trade because you were wrong. Okay. Don't hold hope because your position size is much bigger. Okay. Hear me out on this, guys. $3,000 is your position size, right? And by the time this thing retest here, you may be down 10 to 15%. Okay. 10 to 15% of that 3,000. So if you keep holding and hoping, right, your option could be down 50%, 60%, and you lost half of your half of the amount of the $1,500. You don't want that to happen because, right? You guys know it's a $10,000 account. You're already using a big position size for a day trade. Don't hold on hope for a day trade, right? If day trade, you're wrong, especially if your position size is high, get out immediately. Don't wait for the 30% stop loss, 40% stop loss. If you know you're wrong at 5% stop loss, get out. Live to fight another day. There will be another trade. The market's not going to go on vacation. Okay. The market will be there next day. But if you don't have money to trade in the stock market, right, you won't be there. So always be in a defensive mode when it comes to stop loss. When stop loss, if you think that you're wrong on a trade, get out, right? Especially if you're having a big position size. All right. Hope that answered your question. Anyway, so next example is Fibs. If you're using Fibonacci retracement levels for a day trade, for a trade entry, then the next closest level should be your stop loss. This is most effective for day trading, right? All of you know what a Fib is, right? This is a classic downtrend, right? This is the 1 levels here, the 0 levels here, and you see the stock popping back up, all right? Now, your idea for traders, you want to short the 50% retracement, all right? You want to short a 50% retracement. That is a solid idea. The stock had a $10 drop. It's popping up. You can see the momentum on these candles is like very indecisive now. Maybe it's going to reject here. So let's say you shorted here. You bought puts here. Okay. So if you bought puts here, your stop loss can be the next level. So if the stock gaps up and breaks the 61.8, then you can stop out. Okay. Now, alternatively, again, this strategy can also be adjusted based on your position size. So let's say you only shorted half of your position size. So if your position size is 3,000, you added 1,500 here. Now, if the stock gaps up to 61.8%, the selling pressure is going to be high here, a lot high here, right? So you can add the rest of your position here. And if it breaks the 61.8, you can stop out. Okay. So it's all about managing your position size, and percentage-wise, you won't lose a lot if you scale into trades like this, right? This is a very nice strategy, guys. If you trade the market open, you won't have time to scale in and do all of that adjustment, right? But if you're trading sometime after first half an hour, right, you have a lot of time on your hands, even for a day trade, right? You don't have to go all in because the price action is very slow. Why do you think all the new traders like to trade once everything settles down? It's because it's easy. Candles don't make like crazy moves. It doesn't snap back. It doesn't snap down, right? Premiums are settled down. But price action is more smoother. Volume is obviously low, so you won't see these drastic moves, right? But it's a lot safer. So you don't have to go all in on a trade from the get-go. You can add, you can get the perfect average, especially if time is on your side. Okay? Does that make sense? Can I get a yes? This is something you guys got to take to your head, especially once you grow your account to a big account, right? You don't want to go, if you have a 50K, 100K account, you don't want to go all in on your position from the get-go, right? Be patient. Remember, you guys got to think like professionals, right? You got to get the best average. You got to get the best entries, best exits. Okay, you got to start focusing on more on that so that you guys can get better over time. All right. So some real examples here. I want you guys to think with me on this. So this is the 60-minute chat. Sorry, I said chart. This is the 60-minute chart on Wayfair, W. All right. All of you know Wayfair, right? Last year, they got into a scandal where people were accusing them of smuggling kids in their cupboards, right? Have you guys seen the memes? Like people are accusing that they were smuggling kids in the cupboards. Like it was hilarious, at the same time scary, right? That's this company. Anyway, yeah, in the furniture and cupboards and everything. Anyway, so this particular trade is something that I was watching. It's again one of my favorite setups. Big sell-off, then consolidating under a tight channel, right? So what I was watching was this trend line here, right? And this green line here was an area of confluence. Remember, this is the 60-minute chart. So I see a high here, macro level. There is another macro levels here. a lot of macro here, breakout, reject here, breakout, reject here. But you guys can see that this is a solid level, 295, 296 around that level, right? So the area of confluence here is the break of the trend line and also the break of the resistance, all right? Now, just by looking at this trade, I banked, right? I obviously banked, right? Yes or no? Obviously, I couldn't have lost money on this trade. Yes, right? No, right? I couldn't have lost money. This is the probably like, look at this. Stock was at 295. This went to 340 in 1, 2, 3, 4, 5, 6 hours. Right? It's a crazy chart. Right? There's no way I could have lost money. Now, I'm going to show you guys something. This is the same trade in the 5-minute chart. Okay, this is the same trade in the 5-minute chart. Let's see what happened. Here is the trend line. Here is the break, 296. So market opened, it popped up, hit this level, and then big rejection candle. Big rejection candle. A lot of people, whoever bought here, oh, I'm going to get in here. Unravel had a trend line. Oh, I'm going to get in. It's going to go to the moon, right? I have the trend line. Unravel, I can't just lose. I can't lose. Can't lose, won't lose. He has that posted on his wall and everything. So that's the guy, right? He has a Red Bull. He's all amped up, right? So he thinks he can't lose. So he gets in, and then events are go opening candle, volatility is at all-time highs, or days highs. So he gets in, bam, market slaps him. And then it's like he breaks his keyboard and they're like, no, it can't happen. So this can actually trigger stop losses, guys, because let's say you bought at 298, the stock dropped all the way close to 292, right? So obviously he could have lost like 50% if he bought the open, right? He could have lost a lot of money. But let me break down this trade from a professional standpoint. Okay. So the first thing about that's wrong with this setup is the trend line is fine, the breakout level is fine, right? The first thing you got to see is the lead up to the breakout. Obviously, there is strong momentum, right? So there is a pullback and the stock did go. But when I look at a 5-minute chart, right? The market opened from 292, the stock made an $8 move close to 300. Okay. Stock made an $8 move close to 300. So people who ever bought here, who bought here, they've already deep in profits, right? So when the stock hits a psychological number like 300, okay, there are going to be a lot of sellers forming a big wall. Okay, this happens all the time, no matter how great the stock is. If it adds key psychological numbers, there are going to be big orders waiting. Okay, since the stock made an $8 move, the first attempt when it tests this level at market open, a lot of people took profits. Okay, that's what happened here. So what you could have done, number one is, even if you traded the breakout of this 296 level, you should have taken profit before the stock rejected at 300. That is one way to approach the trade. The second way you could have approached the trade is you could have waited for this $300 break. Once the breakout is confirmed, you could have entered. All right, you could have entered the trade once the breakout was confirmed. The third approach, which is that my trick that I'm going to tell you is, whenever you're trading the market open, especially the first 5-minute candle, you guys know that I trade the first 5 minutes like almost every day, right? There is one major rule that you have to follow. All right, hear me out on this. The first candle is called as the sentiment candle in the market, right? It's called the sentiment candle. It's the most, you get the most volume on the first 5-minute candle. All right, the most trading activity always happens at the first 5-minute candle for most stocks. So if you see the stock open strong, right, and close near the highs, chances are it's going to continue. But if it rejects, always have the tail of the candle as your stop loss when you're trading the market open. Okay, this is very important, guys, right? Because when you're buying options in the first 5-minute candle, you're buying at peak IV. IV is going to be high. You're paying a lot in premium, right? So if we see a big rejection happening here, you don't know, especially if it breaks the support, the first 5-minute low support, you don't know how low the stock can go. Maybe next low level of support is here or here. Since you bought here, you could easily be down 60-70% on a weekly option. Okay, so what you could have done is you could have even bought the breakout here, right? But you didn't have to stop out of this trade because the low of the candle does not break. This happens a lot of times in the stock market, right? Therefore, take my Apple example today. Go to my Instagram, check out my Apple chart today. This is exactly what happened for Apple. Market opened, right? Sell off happened, low of day held, I bought my calls there, right? Low of day held around 171, bought my calls there. I took profit around 172.5 or something. All right. So always have the low of the first 5-minute candle of your stop loss if you're trading the opening 5 minutes. If the low of the 5-minute candle holds, then there is a good chance that the stock is going to retest the high of the day, current day. All right. And if it breaks the current high of day, you're going to bank. Okay. Does everyone, is that making sense? This is a very important strategy. This is a very important risk management tactic that you need to know if you're trading the market open, especially for bounces and whatnot, right? So if you traded about, let's say you bought the bounce here, okay? And let's say the stock went like made a $5 move, but you didn't take profits, right? You're kind of hoping that it's going to go up. Have your stop at the tail of the first 5-minute candle, all right? First 5-minute candle tail, low of the first 5-minute candle needs to be your stop loss. All right, because it's the first 5-minute candle is the sentiment candle. It's going to set the sentiment for the day. First 5-minute candle strong, chances 9 times out of 10 there is going to be continuation. Okay, take a look at any chart you want. You see the first 5-minute candle sentiment. You see that momentum set. It's going to continue at least a few more candles before it hits the supply. All right, so that's how you can approach this trade. And once you're in the trade, you guys can see how very nice it respects the level. 300 breaks, goes to 305, pulls back. 300 support held, and then it started to ride the 8. This is the 80 EMA, 21 EMA, 50 EMA, and then I think this is the 200. This is my old chart. I don't remember the colors. All right. Is that making sense? This is how you don't stop out at trades. Now you see how I had a plan for all scenarios, right? If you're charting like this and have a plan, you need to think like this. Okay. That's why I went into such detail. I explained it to you. You got to think like this. Start thinking like this. Even if you don't think like this now, start thinking like this. Try to understand the chart. Try to understand the story behind the chart, because that's how you get better. Trust me on this. Okay. All right. So next is the pin bar strategy. So for the pin bar strategy, your stop loss needs to be placed behind the tail of the pin bar. So first, let me explain what the pin bar strategy is. So all of you know that this is a bullish hammer or a pin bar candle, right? So the sentiment, the story behind this candle is that the market opened here. The stock opened here at this level, went as low as here, bulls bought the dip, and price closed near the highs. So when you see a candle like this happening, especially at key support areas, bounce areas, demand zones, whatnot, the chances are very high that price is going to go up, right? It may take a few more candles, but it's going to go up because this candle set the sentiment for the interim period, right? If you enter it, I do this all the time as well, by the way, guys. So I do this all the time as well. So if a key support area, I find something like this happening, consolidation happening, key area, I see consolidation happening, I scale into positions, right? And wait for the continuation to happen, and I get bank on that reversal, right? So the key element here is, even though there is a sentiment candle here, even though it's at the support, that market can always prove you wrong. And this happens all the time, right? So if the market decides that your pin bar setup is invalid, and it decides to break this tail of the pin bar, you stop out of the trade. Okay, you stop out of the trade. Now, obviously, the range of the spin bar is very important. So I'm talking about day trading here, but this also applies to swing trading. Let's say you bought a swing trading setup pin bar off of the 50 MA, right? Let's say you do that. All right. So if you do that, decide to play continuation, definitely have the 50 MA, the pin bar low as a stop loss. If the pin bar holds, maybe it's not going to continue next day, but maybe it may continue the following day. As long as the support holds, chances are high that your stock is going to go in your direction. All right. This is something that you need to ask yourself. Like, especially I see a lot of people, should I get out? Should I get out? Right. You shouldn't, if you're a professional trader, you know why you enter the trade. Obviously, you should know why you should exit the trade. Right. There's no insult or no nothing. That's how it's supposed to be. And that's what pros do. And that's what you guys should do as well. Right? You guys need to think of yourself as pros, because if you don't believe in yourself, no one else will. Okay. All right. So that's the pin bar strategy. And next is the break even strategy. The process of moving stop loss to break even point after entering a trade is known as break even strategy. Conservative traders use this strategy to eliminate risk completely and protect capital. Remember, a trader must remember that there are no risk-free trades. A trader's goal must be to minimize risk, not eliminate risk completely. Okay, so this is very important, guys. I know a lot of people that used to do this. Okay, so when they enter the trade, right, like the soonest the stock looks like it comes to their break-even point, they get out. They don't even give the trade enough time to play out, right? Because they're too scared to see red on their P&L, right? So they just get out. They're very, very conservative. So if you do that, let's say you have 5 to 10 good setups, and you do that to 8 of the setups because you see a little red, you are going to be like hitting your head on FOMO all the time. You're going to like lose yourself, right? You can't be that conservative. You can't be that scared of the market, right? The way you need to approach the market is you are putting up risk to make money. No investment is without risk. If you open a store, if you open a business with your friend, if you like, I don't know, send a risky text to your girl, right? It all comes with risk, right? There is without risk, there is no reward, right? You guys know what it is, right? Anyway, I should have gone there, right? So there are no risk-free trades. You can minimize your risk, right? You can say that you meant to text someone else or whatever, right? You can minimize your risk with lies later, but you got to stick to your plan. All right. Oh my God, I can't believe I said that. A trader must remember that there are no risk-free trades. A trader's goal must be to minimize risk, not eliminate risk. That said, capital prevention, it's not prevention, it's preservation. All right. Capital preservation is vital in order to be a successful trader, so that a trader can employ the strategy on a case-by-case basis. All right. All right. So next is percentage stop loss strategy, probably the most popular strategy among TikTokers and a lot of traders as well, right? So what is percentage stop loss strategy? This is probably the easiest one because they just make it so simple, right? So some traders use a percentage stop loss strategy in their day and swing trades. The idea behind the strategy is to minimize losses and losing trades by setting a fixed stop loss percentage. For example, if you enter the trade, you hold until your 10 to 20%, whatever number you decide, that stop loss percentage is hit, right? So if you risk $1,000, right, 20% hits, you're out, right? 200, you're out, right? It's a very simple strategy. You're going to get out without relying on anything. You just rely on this percentage and see that number. Okay, I'm out. I'm going to try my luck next time. Okay. Now, assuming the trader, this is a very important point. Assuming the trader has a very good win-loss percentage and a very fixed position size, the trader is expected to offset losses through winning trades, right? So let's say that you have a $10,000 account and you're using 10% of your accounts for trading. So your position size is $1,000. That's 10% of 10,000. And your stop loss is 20%. So at the minimum, you're willing to lose $200 on the trade, okay? On this trade. So let's say you make 5 high quality trades per week. You only trade the highest probability setup. And you have 3 winning trades and 2 losing trades. That's a 60% win rate. It's a very good win rate. He or she is expected to lose $400 maximum. 2 losing trades, so $400 on a 20% stop loss, right? Assuming they follow the stop loss. The trader makes 50% return on the other 3 winning trades. Good winning trades, high quality trades, 50% will be easy on an option, especially if you have a small position size. You can hold for a couple of candles and you will get 50% return. Then you made 500 into 3, $1,500 profit. If you subtract the 400 loss, you'll be making $1,100 per week with just a $1,000 position size. Okay. So $1,100 per week multiplied by 4, that's close to 5K per month, right? Just by using this systematic approach. So I did a small account challenge like last year. Like this is the kind of strategy that I employed. I'll go over it tomorrow, how I grew my account. But this is the kind of strategy that I use because it's simple. For small accounts, your risk will be very low. So even if I risk 500 on a trade, 20% stop loss is very small, right? So I can use that. Okay. So the key here is to only trade when there is a valid setup. All right. Do not take random trades. Focus on high quality trades. Even if you make 5 trades per week, right? Even if you make 5 trades per week, your win rate will be very high and you'll be able to grow. It's all about the numbers game, guys. I see a lot of people even in the chat, right? They want to trade from morning 9 o'clock to 5 o'clock, like till the market opens, till market close, because they're used to that. right? Oh, I want to trade the whole day. I'm going to grind. I'm going to grind. I'm going to, out hustle everyone. No, that's not how you do it in the stock market. In the stock market, you wait for the perfect setup. When the setup comes, you trade it, and then you take profits. If there's nothing else, you call it a day and come back tomorrow. You can't get rich overnight. You can't grow, like become what you want to become on one day, in one day, right? So you gotta focus on the numbers, try to hit your goals and call it. This is something that you'll have to start doing if you're going to be a professional trader. Okay. Because the longer you stare at your screen, and the longer the urge to trade everything that moves, everything that, like, every little price action you'll want to trade. Don't do that. Okay. That's a bad habit. It's leading to addiction. Don't do that. Okay. All right. So that's percentage stop loss strategy. And then now we're going to switch it up a bit. We're going to go over the different types of orders. So first order is market order. I am sure that a lot of people already know what a market order is, right? So, but if you don't, I'll explain it to you. So market order seeks execution at the next available price. It guarantees immediate execution, but it does not guarantee execution price. Okay. So this is like, going to a store and saying that I don't care how much it costs. I just want it now. Okay. That's exactly what you're saying to the market. I don't care how much it costs. I want 100 shares of Apple now. That's what market order is. You may get Apple at 120 or 150 or 200. You don't know what price you're going to get at. All right. So that's market order. It seeks execution at the next available price, whatever is available. It guarantees immediate execution, but it does not guarantee execution price. What is a limit order? Now, I don't use market order for options at all, because think about it. If I, like, let's say market opens, Tesla spreads, it's like 750 to 1,000. Bid is at 750, ask is at 1,000. At market open, first time in a candle, not a lot of volume is there, so the chain is all over the place. Now, if I just hit market order, when the real price is 760, and instead I get filled at 1,000, right? Let's say I bought like 50 contracts. The moment I bought it, right, I'll already be down 10,000. Right? The moment I buy the contract, I'll be down 10,000. If price does not move in my favor, I'm down 50,000. Right? You don't want to deal with that at market open. You'll feel like hitting your head for being impatient. So don't do that. Sometimes here, this is some good advice coming from a good place. Sometimes you will miss trades because you may not get filled, but that's much better than losing a crazy amount of money because you were lazy. Right? So don't do market orders on options. That's my advice. Right? It's very risky, especially at market open. So what is limit order? Limit order seeks execution at the price you specify or better. It guarantees the price, but it does not guarantee execution. So this is what we use to trade options, especially. So let's say for market opens, we usually hit buy the ask, our active trader, or sometimes even manually, right? You can buy the ask or buy the midpoint. But when you hit a limit order, you're saying which price you want that thing at. So going to a store and you're saying that, hey, I have $200. I'm only willing to pay $200 for the sneaker. You can sell it to me for 200. Otherwise, I don't want it. Okay. That's what you're saying. The guy sells it to you for 200. Okay. You're going to taking home some Air Jordans. Otherwise, you're just going home and wearing your, I don't know, Crocs. Okay. So that's limit order. And then stop loss order. So what is a stop loss order? Right? Stop loss order indicates you want your stop order to become a market order once a specific activation price has been reached, right? So this is what you're here to learn. I'm sure not a lot of people know this, but TOS actually allows you to set stop losses through their application. Okay. So how do you set stop losses? First of all, what is a stop loss in an options order, right? So currently, let's say bid is at 163. Ask is at 170. Okay. Let's say you bought this contract for 150, or let's say you bought this contract for 130. Okay. You're already up decent amount. All right. And what you don't want is to lose money. All right. So what you're trying to say is if the price of the option drops to, let's say, 150, I want to get out. I don't want to lose my gains. I'm going to get out. All right. Alternatively, let's say you bought an option contract for 170. All right. You bought the ask, you just got in, right? but instead of, you thought that Apple's going to reverse, but instead of reversing, it started dipping. So you're saying that, hey, I bought this for 170. If the option contract dips below 150, the premium dips below 150, I want to get out. All right. So that's a stop loss. All right. So in this example here, I have 10 option contracts of Apple. Let's say I bought it hypothetically for 170. I'm setting a stop order type to stop, and I'm saying 10 contracts. Mark is nothing but the midpoint price, so between the bid and the ask price. All right. And I'm saying stop at 150. Okay. So basically, if the midpoint of this option contract drops to 150, a market order will be submitted and I'll get out of the trade. Okay. The execution is going to happen automatically. I don't have to do anything. Once this price is reached, I will get out of this trade. So that's a stop order. Okay. And the next is stop limit order, right? Yes. So that's the next type. So first one I told you, this is a stop order. This will execute at a market. So when the stop gets hit, a market order will be submitted. In this example here, stop limit, I get to specify the limit price. So basically what I'm saying here is that when Apple's option premium drops to 150, I'm saying that I want to submit a limit order to sell this option contract at 145 or better. Okay. So you get to specify the limit price and stop limit order. That's the beauty of this one. Okay. Again, a caution here. When you set a limit order like this, right? Let's say it's a fast moving market. The market's dumping like crazy. Sometimes the options can skip premiums and you may not get filled if you do a limit order. So if you just go play golf thinking that you have a stop loss on your options and the market dumps, sometimes you may not get filled. So you may not get the protection you sought. Okay. So that's why this is a little risky, but this one you get out, right? You get out, period. Okay. You get out, period. At least you get to, you know, you can sleep well knowing that your stop will protect you. Okay. And next is trailing stop loss order. What is a trailing stop loss order? Trailing stop loss orders can be regarded as dynamic stop loss orders that automatically follow the market price. You can use these orders to protect your open positions and let them run its course to maximize return. Both are accepted only for stocks that trade on the NASDAQ, NYSE, and Amex exchanges. So let's take a look at this example here. Let's say I originally had Amazon, right? I had Amazon 30, 50 calls, I had 10 contracts. I took profits on 9 of them and I want to leave a runner, right? I want to leave a runner. Okay. So when I want to leave a runner, what I'm hoping that the stock continues to go up after I exit the trade and I milk as much as I can out of this one contract as much as possible. Okay. So currently the price of this contract is $41.95, $42.90. Let's say Amazon goes to 3,100. Maybe this contract is going to go to 100, right? Or 50. Right? You don't know how much it's going to go. So if the stock keeps going up, I get to make a lot of money off of this just as one contract. That's the beauty of runners. You don't have to monitor it. You just let it run. All right. So how does this work? So let's say you have Amazon 30, 50 calls and the current price is 42.50. That's around the mid price. Instead of using a stop loss order to cut your losses, you set a trailing stop loss order with an activation price of minus 50 cents. All right. What does this mean? This means that the trigger price, that is the stop loss price, will be 50 cents lower than the highest price the option attains. So for example, if the option moves up to $50, let's say the stock rallied like crazy, the asking price for this goes to 51, mid price is around 50. Okay. And after it hits that level, Amazon starts selling off like crazy. Okay. It starts selling off slowly, right? So what's going to happen if the highest price of the options is 50 minus 50 cents, which is my activation price, will be my stop loss price. Okay. So I set 50 cents as my activation price here. If the option rallies to $50 and then it reverses, I know the high of the option price is 50. So when the stock reverses, what it's going to do, right? 50 minus 50 cents, that is 49.50. When the option hits 49.50, an order will be submitted and I will get out and I'll be able to take my profits. Okay. So only this strategy is very useful if you think the stock is going to keep running. right? And when it stops running and it reverses, the activation, the stop loss price will be calculated based on the high price of the options minus the activation price. Okay. Yeah. For Roku, this is the perfect example today. Like imagine if I just left one or two runners, right? Right. Like would have made like probably like $5,000, right? Because stock ran $15 after that, right? $20. Okay. This is the trailing stop loss. All right. Yes, this is actually an option. This is available on options. All right. Again, this is only for stocks listed on NASDAQ, NYSE, and Amex. Don't look at some penny stock and think that it's going to be there. It's not going to be there. All right. Yeah, some platforms do not allow it. Some platforms allow it. TOS allows it, right? Some platforms do not allow it because it's complex and they may not have the resources to, do that. But again, you can do trailing stop losses yourself, guys, right? If you can you guys hear me? All right. Anyway, I didn't say anything much. I was just singing a song, so you guys didn't miss much. Anyway, so what I was saying was I don't use this, right? Personally, I don't use this. We probably have drilled in all that information to your head. Do not take random trades. Only take trades where you have a plan. Okay. You need to have a rationale. Let it be a breakout, bounce, reject, whatever it is. You need to have an entry price level that's based on technicals. You need to have profit target levels, meaning you need to know where the next level of resistance is, or you need to watch price action very carefully. You need to have a stop loss strategy, whether you're going to scale into your position or average down, or you're going to cut loss based on market conditions, what your position size is, what the time remaining until expiration is, right? If it's a day trade and the original intention was to just scalp, don't keep averaging down on a contract that has a very low delta, right? If delta is zero, no matter if you have averaged out like million times, your contracts are not going to move. So don't do that. You're just like buying contracts on something that's dead, right? That's not going to become alive, right? It's not going to come back alive. It's dead. Like, stop feeding it, right? So don't do that. All right. So next is risk management. We'll go over this tomorrow. So risk management, you need to focus on position sizing and how to manage trades. Trade management is everything when it comes to trading, right? You got to manage trades correctly, when to leave runners, when to get out, when to scale out, when to add, like you need to know all of that, right? So have a trading plan. And the next is follow your trading plan. This is easier said than done. A lot of people have all these beautiful charts, like watch lists and everything, but how many people actually follow through on that, right? How many people actually follow through on that? You guys got to take a look at that. That's harder than it seems, right? You can have all the charting work, you can talk all the thing, but you have to take your trade risk money and make money. That is hard, right? So follow your trading plan. Initially, it's going to be hard. I'm telling you, it's not going to be all flowers and roses, right? It's not going to be like that. You're going to get hurt, right? But follow the plan. Then evaluate what happens after that. Rinse, repeat. It may not work now. It may not work next month, right? It may not work 2 months from now, but it will work. You'll start seeing results 6 months from now. And then 1 year from now, you're going to be a very profitable trader, right? It does not happen overnight. Gather through your head. I don't care what that TikTok guy said or what someone on some other chat said, like it doesn't happen overnight. Okay. Don't believe all that. And then, all right. So follow your trading plan. Do not be emotional and impatient when price does not move in your favor immediately. Allow time for the trade to play out. With proper risk management, you will know what you stand to lose if the trade does not work out. As long as you know your risk, you can follow your trading plan without worries. All right. And then rule number 2, very important. Red days are unavoidable. Don't beat yourself up over trading losses. They are unavoidable. If you're down big on a given day and feel mentally exhausted, do not force any trades that day, as it may result in even more trading losses. I'm sure this has happened to most of you, right? When you're emotional, you will make mistakes without even realizing it. For example, let's say a market opens, you're feeling very confident, new week, new year, new me, just had a fresh new PC, you're like pumped for the markets, right? Market opens, you bought Tesla calls, then immediately you're down $1,000, right? Oh my God, you're just like in a downward spiral. Oh my God, just been 1 minute and I already lost $1,000, right? Your mind will be all over the place. It'll be processing the loss. So if you force another trade, let's say 2 minutes later, without a sound game plan, because you saw someone else say that, oh my God, Facebook printing, someone like, or else Amazon printing, like, or Nvidia, great move. You'll get carried away, right? And you will take another trade. After 4 green candles, you'll get in, and then it'll pull back. You will lose money, right? You'll add to your loss. So what's going to happen? The second loss will feel small. So $1,000 was your first loss. Second trade, you only lost 400 or 500, and it won't feel like much compared to the first loss. But if you keep trading and trading and trading, right? The next loss it's going to be 300, then 250, then 150, then 100. You feel like, oh my God, I'm getting to that one green trade, right? And then you're taking another 500 or $1,000 loss. End of the day, you look like you had a $10,000 account, but you only have a $4,000 account now, right? This has happened to countless people. This has happened to countless people, and they regret losing 60% of their account because they were stubborn that one day, and it's not their fault. It's not their fault at all, because their mind was all over the place. They were, money hurts, guys, because if you lose money, and like no matter how big of a trader you become, when you lose money, it will hurt, right? So when you're down, call it a day. When you're down like that, always have a down limit. So for me, my down limit, I have my down limit is different now, right? So when you have a down limit, get out. All right. So $5,000 is your down limit. $500 is your down limit. Call it a day. Don't trade. Market is going to be there tomorrow. Always remember this line. There will be another trade. There will be another trade. There will be another trade. So don't force it that day, because it may not even be you. It's just the market. Okay. So the market will be there, but if you don't have capital, market will be there. You won't be there. Okay. Preserve capital, especially when you're going through something, some loss or a patchy streak. It will happen. Nothing you do will work out sometimes. It's happened to me a lot of times, right? So don't force trades when that happens. Okay. The goal should always be to learn from red days and come back stronger. So I had a red day like a couple of weeks back. I lost like 36K, right? 36K. That was my last red day. I mean, I followed my plan to the best I can. I could have hold and like average down and ended green, but I felt like that wasn't worth the risk, right? So I called it a day, and I learned from my mistake, and I was able to avoid the same mistake a couple of days back, right? Okay. So next, review your trades daily, right? Review your trades daily and see what went well and what didn't. I do this every day. Even today, I did it, right? Log observations in Excel or trading journals. Trader View is the journal that I use. It's very easy. You just get Excel from import your trades from Trading Think or Swim, and then I import it to Trader View. All right. Trader Sync is another online journal. You can use it. I tried it, but I prefer Trader View. Or you can go old fashioned and then do notes, right? Just take your notes. All right. Be selective with your trades. Focus on quality over quantity. Avoid choppy markets. This is a very important line, right? So you don't have to take 10 trades, 15 trades, trade from morning to the evening. If you can only see 2 or 3 good stocks that day, take some trades, make some money, call it a day, right? Don't overstay or welcome on trades, because it can hurt you, and the FOMO will result in bigger losses, right? If the market is choppy, if you don't see anything that's good, don't trade. Market's going to be there tomorrow. Okay. You got to have this elite mindset, guys. It's very important. Improve your standards, like get your standards high, right? Don't take something that's not worth it, right? Especially last week when the holidays were there was nothing worth trading, but people continue to trade all day and they lost money. Why did you buy calls? Like the market's selling up, no one's buying. Everyone's turned off the printer, right? And next, do not have too many open positions at any given time. This is very, very true for all trades, especially for new traders. I see someone have a $5,000 accounts and they have like 10 different open positions, right? Don't do that. Don't do that, because you may have everything spread out like very nice, but if Jerome Powell comes on and says something, everything dumps, all your call options are going to go to zero, and you may lose everything. So don't do that. You may think you're hedged or whatever, but anything can happen. If you don't know real hedging, you may You may, especially if you're a small account, it can hurt you. Okay. Log your win and loss percentage. That is, maintain a trading journal. You want to see yourself making progress. If something is holding you back, you may want to address this issue. Logging your win and loss percentage and position size, that is the amount you're risking in every trade, can help you determine what you can do to step up your gain and increase your profits. This is important, guys. I'm going to ask you guys a question. 1 year from now, 1.5 years from now, do you want to be the same person you are today? Yes or no? The answer should be no. Like if you say yes, then I hope that you are Bill Gates or Elon Musk or someone like that. Even they won't say no. Even they won't say yes, right? You don't want to be the same person. You don't want to be stuck in one place, right? So you have to learn to improve as a trader. How do you improve? You only improve by, or you only improve by studying yourself, analyzing your performance, right? And see where you went well, where you didn't, and then try to improve your trading, right? That's how you do it. All traders do this. All good traders do this, right? So you have to start doing this as well. Okay. And only when you learn more about yourself, then you know that, okay, my win rate is 70, 80%, right? Your win rate is 70 or 80%. You're trading with $10,000 now. So you may say, okay, I've been doing this for 6 months. What if I increase my position size to $15,000? Will this affect my win rate? Backtest this data, do it for a week and see what happens. If your win rate is not affected, then you're going to make more money. That's how you steadily increase. You evaluate your performance and then you slowly improve. All right. And then do not compare your trading journey with anyone. Let it be profits, let it be losses, let it be experience, let it be trading style. Especially if you follow someone on social media and whatnot. Just remember that in this day and age, half the people out there are lying just to look better. They are projecting themselves as someone they're not. So do not believe everything on social media and say that, I wish I was that guy. Like, look at that guy. It has is better, right? Don't think that. I used to be like that guy. Man, I used to like, look at all these traders, right? Man, I didn't see any setup. How are these guys making so much money? Like, there's nothing happening. And then someone, 2 months later, someone comes out and, oh, this guy is paper trading. They just comes out and, oh, that's why this guy is cap or this girl is cap, right? You'll find out all those things later, right? The longer you're in the trading world, right, you can see who's real and who's not, and it'll be funny. It'll be like, damn, I didn't know that, but you can easily find that out later. All right. But the moral here is, do not compare yourself. No one is better than you. No one is worse than you. The only difference between you and me, right? I'm comparing with me, right? Is that I've been doing this for so many years and you're just starting. That is the only difference. The time put in front of screen is the only difference. I'm not better than you. It's just that I've been doing this more than you. Okay. You can get better than me just by spending more time in the markets. Okay. And I want you guys to be better than me. All right. So break down long-term goals into achievable short-term goals. So a goal like grow my account to $10,000 is a great goal, but you can break that down into make $1,000 every week for 10 weeks. As your account grows, your ability to make more money increases. This game is all about consistency. Okay. So we'll talk more about goal setting in the next class, but breaking down goals is important. You need to know why you're trading all the time. You need to have that in the back of your mind, right? And then don't risk a large percentage of your capital on any given trade. You may think that a certain stock is going to go to the moon, right? But you can't risk everything. You can't risk everything. You can't risk everything on one trade, right? It may go to moon, it may go to hell, right? You don't know where it's going to go, right? The risk reward is not worth it. You may or may not make money from one trade, but there is a good chance you may blow a major portion of your account trying to prove a point. Don't be this person, right? Don't do this. The cloud, it's not worth it, right? Like I said, there will always be another trade. If you go all in on GME earnings and GME goes to zero, you lost all your money. The market's going to be there. GME is going to be there. They're just going to file for bankruptcy and they're still going to sell, or they may get acquired. But your calls are going to zero and you don't have money to trade the next day. So don't risk everything on a one trade, no matter how good this is. This is not Vegas. This is the market. We don't do that. Okay. And then be realistic. Don't be crushed by your own lofty expectations. You're not going to become an overnight millionaire. So don't have lofty expectation. Just because you attended a few classes doesn't mean that you figured it all out. Like I said about bounces yesterday. Don't think that you know bounces already. You just started learning about it, right? So have to spend time, master the craft, backtest data, make some money, build some routines. That's when you get good at it. Okay, so don't be realistic, guys. Try to make short, achievable goals in the short term. That's how you get better. All right. Then treat trading like a full-time job. In your 9 to 5, you won't submit a report or go to not attend a meeting or make major decisions without doing due diligence, right?